Hello everyone, welcome to the market overview video. The topic of the discussion is, are we heading into a recession? The market sell-offs, and I'm talking about stock market, right? Sell-off has actually accelerated in last 2 weeks. Technically, we are very close to being in a bear market territory. So what I thought was comparing the recent market action that we are experiencing now to the last two bear markets that we saw in 2000, 2001, and 2007, 2008, and see if we can draw any parallels. So let's start with looking at the current state of the asset classes holistically. This is commodities represented in orange. So as we see that the commodity prices has been rising substantially since last April. Commodities include oil, natural gas, metals, um, grains, and so on. And higher the commodity is higher the inflation, right? It's worth noting that how far commodities has been stretched towards the upside. Second being the US dollar. And as we see that the US dollar has been appreciating vis-a-vis all the major world currencies. The third being bond. And we see that there has been a steep sell-off in the bond market as well. And it's again very intuitive because as the interest rate rises in an inflationary environment, the bond yield decreases, resulting in a sell-off, right? And then the last but not the least, the stock itself, wherein we are seeing the stock market in rapid sell-off mode right now. So this is the current state. Now let's look at what are the bigger forces at play now, again, right? The current status in today's market. Number one, inflation. And if we try to relate this number, inflation, to what we saw in commodities, it makes sense, right? Because commodities have been moving up, right, in quite rapidly. Number two, rise in interest and mortgage rates, right? And again, very evident from the bond market sell-off that we noticed in the last slide. And the third one being USD is strengthening, right? The US dollar is strengthening against the major currencies. So now what we do is, having set the context with respect to the bigger forces at play into today's market condition, now let's zoom into each of these and look at it in terms of where they are, right? So the inflation or the consumer price index data, this is where we are today, right here at about 8.5%. And if I draw this line, you see the last time inflation was this high was somewhere in 1980. All right, so we haven't seen this kind of inflation in last 42 years. And if we compare today's inflation with the last two bear market, one was this one, right, 2007 and 8, and the other was 2000 and 2001. None of them were not even close, right? Both of them were fairly low as compared to where we are today. So that's a point to note, and that's a very, very worrisome point. Second, the mortgage rate, right? This is a chart for 30 years mortgage rate. This is where we are. And if you note, the mortgage rates have been rising rapidly in last 1.5, 2 months, maybe doubled in last 2 months. And if we compare the interest rates here, or the mortgage rates here, vis-a-vis the 2007 and 8, it's again not too far. And again, and we know that the Fed is currently tightening or raising the interest rate. It's just a matter of time before this line most likely would intersect. I'm sorry, let me go back to this. Before this line actually moves up and intersects with this line right here, right? Or if we actually go back to about 2000, 2001, obviously that time it was very, very high. And I'm not sure whether we'll get there, but maybe we'll land somewhere in between, right? Between this line and this line. So in no shape and form, the interest rate situation is any better from what we've seen, in the last two cycles. Or at best, it would be an average, right? The third one is the rise of US dollars. And as we can see, the US dollar in the last 2007-8 time frame was €1 was trading at 1.5 to where it's trading now, which essentially is close to 1 euro to $1, right? And if it gets a little bit more strengthened, the US dollar, I guess it will be very close to where we were in 2000, 2001 time frame. Okay, so again, I guess looking at all these bigger forces, where we are today vis-a-vis the last two bear markets, inflation, very bad. Uh, the interest rate or the mortgage rate somewhere in the middle, and the dollar index fairly high, right? Where dollar has appreciated quite a bit vis-a-vis the last two. So and I'm sort of going through this just to set the context, right, in terms of how they will have a material bearing on the stock market, right? So now let's look at what transpired in the stock market during these two bear markets. So this is a S&P chart of 2000, 2001. And as we see that there was a steep sell-off here, right? Followed by again a rally. And what happens in a steep sell-off, as you can see, right? Market coming down rapidly, right? So it took S&P about 854 days, right, to drop close to 50%, and then, right, it took about 1811 days for S&P to reach at the same level where it was when the sell-off started, right? So overall, we are looking at approximately 7 years in total, right, from here to here, during this cycle. Okay, so quite a steep sell-off, right? Then now let's look at the 2007 and 2008 time frame. Same thing, right? The pattern repeated itself. The S&P dropped 57% in 509 days, followed by 1492 days to reach the prior high again, right? So overall, roughly around 5.5 years to get back to normal. And that's a typical action that, even if you go back in the past, that's a typical action you will see in most of the bear markets, right? So before we get to where we are today in terms of this cycle, I want to bring in one more element or the common theme of both these bear markets. And what was the common theme, right? The common theme was recession. I mean, we have been talking about bear markets, but in both these markets, we actually got into a recession. Now let's look at one of the charts again, right? This is again the CPI data chart. And as you can see, this gray line actually indicates the recession time frame. So this particular time frame was a recession in 2000, 2001, and this was a bit longer in 2007, 2008. And as you can see, prior to the recession, it was inflation that was rising. It was inflation that was rising. And again, it's inflation that's rising. Now, what does it mean? Are we getting into a recession? Well, time will tell, but do we have a chance to get into the recession? I mean, the history tells us that yes, right? Because the buildup is exactly or very, very similar, right? When it comes to stacking up of all the macro parameters or economic parameters that we're talking about. So, as we talked about, the factor leading up to recession is inflation, right? And that's true for those two bear markets and the market that we are in today. What does inflation result in? Fed tightening, right? So whether it's raising of interest rate or stop buying or maybe start even selling securities such as treasury bills. Remember all the tapering conversations, right? Tapering conversation was all about to taper the buying of securities that Fed was engaged in, right? What does it all finally result to? It actually results in reduced liquidity, and it induces demand destruction, because guess what? Inflation, right? I mean, there are two sides to it. One is supply, one is demand. Till we really reduce the demand, the inflation is not going to come down, right? Obviously, you can increase the supply as well, but the problem is in today's market, there is this additional dynamic of supply chain constraint, or the supply chain issue, that the global supply chain issue that we are facing. So supplies have also become a bottleneck, right? So all that has put us, or the stock market, in a very, very precarious situation, right? So finally, how does it impact, right, the stock market? Stock market gets impacted. Why? Because the valuation of the companies get crushed. The valuation is the P multiple, the price earnings ratio. So if a company earlier, let's say, is valued at 70p or 80p or a 90p, may actually be valued at 20 or 30p, right? So big crush there. And then also, because of the headwinds of and inflationary pressures, the earnings also get crushed, resulting in massive decrease in stock prices, right? Now, if you think about what's the stock price, it's nothing but P ratio into earnings per share. Now this denote earnings, this denote valuation, right? And if both of them are getting crushed, guess what? The stock price is getting reduced drastically, right? And that's what we've experienced in the prior markets. So let's look at how the markets behaved, right? The stock markets. So this was 2001 and 2, right? The chart that we just saw. This was 7 and 8, again, the chart we just saw. And this is where we are today, right? In 2021, 22. And as we have seen in both the cycles, it's a gradual grind towards the downside, right? This cycle has just started. Now, am I saying that we have to repeat the pattern exactly the way it was in these cycles? No. But the important point to note is that that's definitely a possibility. Okay, so as we are thinking about investing or trading, this has to be taken into consideration. Okay. Moving on. How did it all start in 2022? I mean, to me, the first big warning sign came on 20th of January 2022. Now, this is the SPX chart, right? And but this is an advanced declining cumulative average of all the stocks that get traded on NYSE. And if you look at it, the first time this cumulative average crossed below the trend line that we see was on 20th of January 2022. And that even in this COVID crash that we saw, right, the whole cumulative average line was not able to breach this trend line, but it did, right? So this was sort of the start of, I guess, in technical terms, something which was pointing to a market sell-off, and that's exactly what happened after that. So now where are we, right? So there's a lot of conversation about growth and value stocks, right? Now growth stocks are stocks that are for companies that are growing rapidly. They're investing the cash generated in their business, to grow their operations. Whereas value are more from defensive sectors that are more mature, that are returning money to the shareholders, etc., right? Now, if you look at the price correction, the first stock that got hit was the growth stocks, because they were very, very highly valued. Their P ratio was quite high. So, for example, this is an upstart, right? It actually moved started from $22, $23 all the way to $400+, right? In no time, literally. And see the very same fashion, as the valuation got crushed, look at what happened to the stock price, right? So this is not an indication of actually earnings reduction in this proportion. It's more about valuation crush, right? Similarly, Square, right, a fintech, look at the free fall. Now, the third one actually is a value stock. This is a Walmart. Now, Walmart is a very, value company, fairly mature. But look at how, it was able to maintain, and it was trading in sideways channel. But look at it where it's now. It's absolutely got decimated in last, I think last 2-3 days. So it's no longer this correction that we are experiencing is limited to one sector. It's growth and value, both. Similarly, let's look at small caps, right? This is UMA, small cap. This is Williams Sonoma, mid cap. And this is Apple, a large cap or a mega cap, right? Now let's look at it. Stock cap, this sell off, right? Medium cap, sell off. Mega cap, right? Apple so far was able to still maintain, right? Its valuation and price, but see what has happened or started to happen. Apple is actually in a free fall right now, right? So this hopefully captures the story here, which is that current correction, stock price correction, is not limited to one sector or one kind of stock, right? So more importantly, what's next? Now here are the considerations, right? So the $1 million question is that, are we heading for recession, just like the other two time frame we talked about? Would Fed be able to provide soft landing? A lot of discussion these days is about soft landing, and soft landing is nothing but sort of being able to get rid of the inflation by disrupting the demand side of things, right? By decreasing the money supply, which is, in other words, Fed tightening, but yet avoiding recession. And if Fed is able to do that, that's what its soft landing is. Now, we saw in the chart earlier that there has been no soft landing, right? So would Fed be able to do it? Time will tell, but then, I have my doubts, right? Looking at the past data. The other very, very important consideration, right? And this is one of the thesis of bulls today, that would US consumer continue to stay strong? Because as long as the US consumer stays strong, right, the bull thesis is that, the economy will not get into recession and we'll be able to weather this storm, right? And inflation will peak and come down and everything will be back to normal. But with the recent events, what we saw with Walmart and Target, right, and the commentary that came from their earnings call, this US consumer story seems to be weakening a little bit, right? And this is something which is very, very important for us to monitor, right, going forward. And the fourth one being that, would US labor market continue to be strong, right? So definitely this market has been extremely strong, and this is again one of the points that the bulls have in market today, that if the labor market is so strong, right, then there's just no chance of economy getting into recession. So these are the important considerations, something to watch for, I guess, in the next month or 2 months or 3 months, as the Fed continues to tighten, raise more rates, etc., and see where we land. But very, very important points to keep a tab on. So we are in changing paradigm, right? The paradigm is changing quite a bit. As discussed, we are experiencing both valuation and earnings contraction. It's just not about buying the dip anymore, right? Because the market trend has changed. Also, remember that in today's market, there may be rally, right? There may be bear rallies, there may be, short covering rally. But as we have seen, most of it are short-lived. And you don't want to be buying when the large institutional investors and hedge funds are dumping, right? So very, very important point. And that's why it's even more important in today's market to actually know a bit of technical analysis, because what technical analysis fundamentally tells you is that what are the short-term and long-term supply and demand levels for individual stocks, even for indexes. Because if you're able to understand what those levels are, you will know that where the buyers are coming in and where the sellers are coming in, and you can trade or invest based on that. So that's one. Also, I want to point out here is that in a market where we are in today, if you trade options, then you know that options provide flexibility on trading both sides, right? So you can trade bullish, you can trade bearish, and you can configure your risk reward depending on what the market technicals are, right? So something for you all to think about or look at. I will end this with a slide on Options Lake, where we are a registered investment advisory firm, and we are very focused on options and stock trading. Our mission is to bring in the advantages of options to retail investors. We identify trades through a combination of right option strategy and technical analysis, right? And we do deliver this advice in a daily podcast format to our subscribers. We also provide standardized learning tools, etc., to for subscribers to understand the fundamentals and advanced concepts as well. And then subscribers have the flexibility to trade in their own accounts, and they can adjust trades as per their portfolio size. All right. There are multiple risk complexities involved in options trading, so please refer to the link here if you to understand all these risks and complexities involved. And if you want to receive more educational or market update videos, you can subscribe to our channels, or you can reach us on the email provided here. So that's about it, folks, for the video. I hope you got something out of it. We'll talk to you in the next one. Thanks. Bye.